Most people believe that retiring early is only possible if you hit the jackpot, inherit a fortune, or earn a six-figure salary. But what if I told you there's a smarter, proven way to retire early without winning the lottery or working yourself into the ground? Dividend investing is the overlooked secret that financially savvy investors use to build a steady income stream, allowing them to quit their jobs years, even decades, sooner than expected. Want to know how to retire early with dividends? Stay with me until the end of this video so you don't miss any details. If you want to learn more about retirement planning, click the subscribe button below the video now. Why dividend investing is the key to retiring. Early, most people saving for retirement follow the traditional approach. Invest in a 401k or IRA, wait until they're 65, and hope their nest egg lasts. But what if there was a way to retire early without constantly worrying about running out of money? That's where dividend investing comes in. Dividend investing allows you to generate passive income, money that lands in your account without selling any assets. Unlike traditional investments, where you need to withdraw from your principal to cover expenses, dividend-paying stocks provide consistent cash flow while your portfolio continues to grow. This is the foundation of how to retire early without depleting your wealth. Think of it this way. If you owned enough rental properties, you could live off the rental income without selling any houses. Dividend investing works the same way, except you don't need to manage tenants or deal with property maintenance. Instead, you invest in high-quality companies that reward you with regular payouts, which you can reinvest to accelerate growth or use to cover living expenses. A key advantage of dividend investing is its resilience in market downturns. When stock prices drop, most investors panic because they rely on selling shares to fund retirement. But if you're living off dividends, short-term price fluctuations don't matter. You still get paid. This stability makes dividend investing one of the safest and most predictable ways to achieve early retirement. Many of the world's wealthiest investors, including Warren Buffett, use dividends to generate long-term wealth. If you want to retire early, focusing on dividend growth stocks could be the smartest financial decision you ever make. The math behind retiring early with dividends. How much do you really need to retire early with dividend investing? The answer depends on your expenses and the dividend yield of your portfolio. But the good news is that with the right strategy, financial independence might be closer than you think. Let's break it down with an example. Suppose your annual living expenses are $40,000. If your portfolio has an average dividend yield of 4%, you'd need $1 million invested in dividend stocks to cover your costs without touching the principal. If you manage to save more or find stocks with a slightly higher sustainable yield, you can retire even sooner. Now, here's where compounding makes a huge difference. Instead of withdrawing your dividends immediately, you reinvest them in more dividend-paying stocks. Over time, this creates a snowball effect, where your dividend income keeps growing without additional savings. The earlier you start reinvesting, the faster your portfolio will reach a point where it fully funds your lifestyle. Another factor to consider is inflation. The cost of living rises over time, which means your dividend income must grow as well. That's why focusing on dividend growth stocks, companies that consistently increase their payouts, is essential. Historically, dividend aristocrats, companies that have raised dividends for at least 25 consecutive years, have outpaced inflation, making them a strong choice for anyone looking to retire early. The key takeaway? Dividend investing isn't just about reaching a number, it's about creating a system where your money works for you. Once your dividend income exceeds your expenses, you've officially achieved financial independence. From that moment on, work becomes optional. The best dividend stocks for early retirement. Not all dividend stocks are created equal. If you want to retire early, choosing the right companies is critical. You need stocks that provide consistent growing dividends, not just high yields that may not be sustainable. So, what should you look for? First, dividend aristocrats, the gold standard. Dividend. Aristocrats are companies that have increased their dividend payouts for at least 25 consecutive years. This track record signals financial strength, steady cash flow, and a commitment to rewarding shareholders. Some of the best dividend aristocrats include Johnson & Johnson, J&J, a healthcare giant with decades of dividend growth. Procter & Gamble, PG, a consumer goods leader with recession-resistant products. Coca-Cola, KO, a global brand with strong cash flow and a reliable dividend. These companies not only pay dividends but also increase them over time, ensuring that your passive income grows to keep up with inflation. 2. High-yield dividend stocks balance risk and reward. While a higher yield can boost your income, it's important to avoid stocks with unsustainably high dividends. Many companies offer yields above 7% or 8%, but if they can't maintain those payouts, they may cut dividends, hurting your income stream. A healthy range is between 3% and 5%, where companies can sustain and grow their dividends. 3. Dividend ETFs, a safer, diversified approach. If you prefer a hands-off strategy, dividend ETFs can help. Funds like Vanguard Dividend Appreciation ETF, VIG, and Schwab U.S. Dividend Equity ETF, SCHD, provide diversification while focusing on strong dividend-paying companies. This approach reduces risk and still allows you to build reliable passive income. The bottom line? To retire early, focus on quality over quantity. A well-balanced portfolio of strong dividend stocks can provide the steady income you need, without the risks of chasing high yields. How to build a dividend portfolio for early retirement. Creating a dividend portfolio that allows you to retire early requires more than just picking a few high-yield stocks. You need a strategy that balances growth, income, and risk while ensuring your passive income remains stable for decades. Here's how to do it. 1. Start early and reinvest dividends. The most powerful tool in dividend investing is compounding. When you reinvest dividends, you buy more shares, which then generate even more dividends. Over time, this creates a snowball effect that significantly accelerates portfolio growth. If you start investing early and consistently reinvest, you can reach financial independence much faster. 2. Diversify across sectors. Relying on just one industry is risky. If that sector struggles, your income could drop. Instead, build a well-diversified portfolio with dividend stocks from different industries such as healthcare, Johnson & Johnson, Pfizer, consumer staples, Procter & Gamble, Coca-Cola, technology, Microsoft, Apple, utilities, Duke Energy, NextEra Energy, financials, JP Morgan, BlackRock. Diversification protects your dividend income from economic downturns and industry-specific risks. 3. Focus on dividend growth, not just high yields. A stock with a moderate but growing dividend is often a better choice than one with an unsustainably high yield. Look for companies with a dividend yield between 3% and 5%, a low payout ratio, less than 60%, to ensure dividends are sustainable. A history of consistent dividend increases stocks that increase dividends over time, help combat inflation, and ensure your purchasing power stays strong. Use tax-advantaged accounts when possible. If you're investing in dividends for early retirement, minimizing taxes is crucial. Consider using Roth IRAs, withdraw dividends tax-free in retirement, 401ks or IRAs, grow dividends tax-deferred, but remember early withdrawal rules. Taxable accounts with dividend-friendly strategies. Holding stocks long-term reduces capital gains taxes. A mix of these accounts can help maximize your after-tax income. 5. Monitor and adjust. Over time, building a dividend portfolio isn't a one-time task. You need to review your holdings regularly, reinvest smartly, and adjust based on market conditions. If a company cuts dividends or its fundamentals weaken, consider shifting to stronger alternatives. By following these steps, you'll create a resilient, income-generating portfolio that can fund your lifestyle for decades, allowing you to retire early with confidence. The biggest mistakes to avoid when retiring. Early with dividends. Dividend investing is one of the most effective ways to retire early, but many investors make critical mistakes that can delay or even ruin their financial independence. Avoiding these pitfalls is just as important as picking the right stocks. Here are the biggest mistakes you must watch out for. 1. Chasing high dividend yields. It's tempting to invest in stocks with 8%, 10%, or even 12% dividend yields, thinking they'll generate more income, but in most cases, excessively high yields are a red flag. Companies that pay unsustainable dividends often cut or eliminate them when financial troubles arise, leaving investors with a drop in income and a declining stock price. Instead, aim for companies with stable, growing dividends in the 3% to 5% range. 2. Ignoring dividend growth. A stock that pays a high yield today but never increases its dividend will lose value over time due to inflation. A company that consistently raises its dividends, however, ensures that your income keeps pace with rising costs. Stocks like Procter & Gamble, Johnson & Johnson, and McDonald's have increased their dividends for decades, making them reliable choices for long-term passive income. 3. Lack of diversification. Many investors overconcentrate in a single industry, like utilities or real estate, because of their traditionally high dividend payouts. But economic downturns can hit certain sectors harder than others. A well-diversified portfolio across healthcare, consumer goods, technology, and financials reduces risk and helps maintain a stable income stream. 4. Failing to reinvest early. If you spend your dividends too soon instead of reinvesting them, you miss out on the power of compounding. The best way to accelerate portfolio growth is to reinvest dividends in the early years, allowing them to generate even more income down the road. Once your portfolio reaches a sustainable level, then you can start withdrawing without harming your long-term financial security. 5. Not planning for taxes. Many investors focus on dividend income but overlook the tax implications. While some dividends are taxed at lower capital gains rates, others, like those from REITs, may be taxed as ordinary income. Using Roth IRAs, 401ks, and tax-efficient investing strategies can help minimize the tax burden and maximize your retirement income. By avoiding these mistakes, you'll protect your dividend income and ensure your strategy remains strong for decades of financial freedom. When can you finally retire early? The moment you've been working toward financial freedom through dividend investing. But how do you know when you're truly ready to retire early? The answer lies in one simple rule. Your dividend income must fully cover your expenses without needing to sell investments. 1. Calculate your required dividend income. Start by determining your annual living expenses. Let's say you need $50,000 per year to maintain your lifestyle. If your portfolio has an average dividend yield of 4%, you'd need $50,000 divided by 0.04 equals $1.25 million in dividend-paying stocks. If your portfolio yields 5%, you'd only need $1 million. This is why selecting the right dividend stocks matters. Balancing yield and sustainability can help you reach early retirement faster. 2. Build a safety margin. While dividends provide reliable income, you need a cushion for unexpected expenses, inflation, or market downturns. Many early retirees aim to have 110% to 120% of their required income covered by dividends before quitting their jobs. This extra buffer ensures you won't be forced to sell stocks during tough times. 3. Test your financial independence before quitting. Before making it official, do a 1-year test run. Live only on your dividend income. Track if it consistently covers your expenses. Adjust if necessary. Reduce expenses or increase investments. This trial period gives you confidence that your plan is solid before you permanently leave the workforce. 4. What happens after you retire early? Once you hit your dividend income goal, you have complete freedom. You can travel, pursue hobbies, or start a passion project. Continue investing and reinvesting surplus dividends. Let your portfolio keep growing, securing your financial future. When your money works for you instead of the other way around, you've officially mastered how to retire early. If you enjoyed the video, don't forget to subscribe to the channel. Click now on the video appearing on your screen and discover everything you need to know about retirement planning.